Welcome to the Stroock Sovereign Wealth Forum. My name is Jason Sjogren. I am the Stroock Professor of Natural Resource Conservation and Management at the University of Wyoming, which I've been there for the last 20 years. And the Stroock Forum is something I've put on now maybe 18 times around the state, a lot of times in Laramie. I believe we have come to Jackson only once before, so I'm glad you guys made the time to come out and get some learning in about sovereign wealth funds. I know it sounds like a fairly dry topic, but it is probably the future of Wyoming, and it's probably the future of the West to understand how it is that we're going to transform our stock of minerals and gas in and wind, thank you. I would throw anything else in there you want to throw in, any of our resources, and to be able to turn that stock into a stock of cash that we can then figure out what to do with. And as I tell my students in Global Economics 1 that get the Hathaway Scholarship, I say, well, we take a stock of rocks and we earn a stock of money, and then we invested in you to get a stock of brains. So yes, indeed. Your brains are made of rocks. And yeah, they get the same kind of chuckle. I go, yeah, great. This is going to be a great semester. I can see this now. So the sovereign wealth is fairly fundamental as part of our being in Wyoming, and it is in many of the speakers here today, including Alaska. Our permanent mineral trust fund is about $7 billion. For 500,000 people relative to the Norwegians, who have nearly 850 billion for about 5 million people. So they've made very different decisions than we have. Oklahoma's trust is 0. They've made some very different decisions than we have. And so part of this process and part of this dialogue is to open it up and discuss the future, because in terms of how we think about these things and how we think about how we're going to fund the future, and we're talking about the long-term future, not just a generation, but we're thinking about share and share alike for a long time. And so as we think about this notion of sovereign wealth in Wyoming, we're thinking about essentially reducing the tax bill to every citizen by $1,000 or nearly $2,000, as opposed to the Alaska experience, which is handing out a dividend. In our way, we just don't tax you as much, so it's the same process. It's just you don't get the money to go buy a truck directly, right? So tonight we are really fortunate to have a distinguished panel, and we are very fortunate to have Kathleen Hayes as our moderator. Kathleen is from Bloomberg TV and radio, and she's one of the top economic reporters and hosts, and you've probably seen her on TV, and we are really, really fortunate. So I'll turn it over to Kathleen.
Well, thank you so much, and welcome. Thank you for coming in tonight. This is, we're wrapping up. All these people here, all these people on this stage, Mark Gordon, Jason, so many people who've worked on this, an amazing inaugural, I think it's an inaugural conference because it went so well to look at sovereign wealth funds. This was the Stroock Sovereign Wealth Fund Conference. It drew people from all over the world, all over the country, and you'll see that as soon as you start hearing from these very distinguished panelists. I'm a financial journalist. I have been for a long time. I studied economics, and I was very interested. Actually, years ago, I was interested in Marxism. I did not want to be the CEO of IBM. I just wanted to help start the revolution, and anyway, so here I am, right? I learned somewhere along the way, you know, my dad, who should have been part of the working class movement, would never have joined, right? I mean, my dad was a logger and very independent. Anyway, so my expertise is actually the Federal Reserve. I've been covering the Federal Reserve for a long time. In fact, the first time I came to Jackson Hole was in 1990, when Tom Honig, who had just become the head of the Kansas City Federal Reserve, and of course Wyoming is a big part of that district, and of course Jackson Hole is beautiful, and I've kept covering the Fed, so I've been out here so many times, and I'm out here again for that, and then I got also this invitation from Mark Gordon to moderate this panel, and I've got to tell you that this panel, this whole event to me has been equally as interesting as the Federal Reserve Conference, maybe in part because this is unique. There's so much going on with sovereign wealth funds. It is not my expertise as a journalist, but it's clear, even if you're just covering financial markets generally and what's going on in the world, that sovereign funds have become a much bigger part, much bigger players. The role, they're growing. And so for me, it's been a terrific opportunity to learn more about them and to get some great potential guests for my radio show. So what we're going to do, the format tonight is they're going to each present one of the aspects that we've heard at the conference the last couple of days that they're most fired up to speak about. Then we're going to kick it around a bit up here and work our way down, and we're going to leave plenty of time at the end for your questions and comments, and we'll be very eager to hear what they are. So, Adrian Orr, to my immediate right, he is chair of the International Forum of Sovereign Wealth Funds, and he's the CEO of the New Zealand Superannuation Fund. He's got a long and distinguished career in central banking in New Zealand. He's done so many things, and it's interesting to me, Adrian, that you, after years of being an economist and being at centers and looking at things, you're practicing. You've really got a hands-on job now, so you have a unique set of experiences to share with our audience.
Thank you, Kathleen, and greetings, everyone. I didn't have an accent until I left New Zealand, but apparently I picked one up on the way over here. So hopefully I can keep hold of it and take it home. It'll be pretty good. And what a smart team. Mark, excellent work, sir. My brain was full by lunchtime yesterday. Fortunately, I emptied it last night, but you refilled it again by lunchtime today. I have learnt a lot on the way through. You are in very, very safe hands here, folks of Wyoming, Jackson Hole, and the things you are doing are absolutely necessary and about time. And you can do some things better, and I will talk a little bit about that. By the way, I say you, I think across a lot of the US state pension funds, the US state investment funds, what gets measured gets managed. And I think you've got a real challenge in the US to measure things that really matter. And what really matters when it comes to this type of work, which I'll explain, is the outcomes that you're trying to achieve. Not about the dollars or cents spent on the way of achieving it. It's about success. It's about achieving the outcome you're after. So I'll talk a little bit. Kathleen, sorry, I was just thinking as well, I think it was Winston Churchill, wasn't it? He said, if you're not a communist when you're 20, you have no heart. If you're not a capitalist, by the time you're 30, you have no brain. So you have both.
I make it on
so
both
well
counts.
done. And I do have the perfect face for radio, if you want me. So it's, thinking about these sovereign wealth funds, by the way, congratulations. America has finally come out and said it's okay to have a sovereign wealth fund. When this moniker first turned up, it was in the mid-2000s, and we were on the front page of The Economist magazine as these crazy, evil foreign investors coming in to buy all of the strategic assets of the US. It is nothing of the case. We were actually marched into the offices in Washington, the IMF offices, where they kind of pulled together. Effectively, it was the Chinese fund, CIC, and then they wrapped a whole lot of other people around it, so it didn't look so specifically racist, and said, you better do something to yourselves before we do it to you, which is prove that you are responsible investing vehicles for economic purposes only, and not for other non-economic purposes. And so at that point, to have the moniker a sovereign wealth fund was just an evil thing. Fortunately, we had the global financial crisis. I bet you don't hear that often. As they say, never let a good crisis go wasted. And within 2 years, suddenly we were the people on the big white horse and the white hat riding in and bailing out and being the providers of long-term capital, being the long-term investors, being the wealth creators for the people of our stakeholders on the way through. So, well done. It's something to be proud of, to be investing on behalf of the people of your area, your community, or your country. It is something that's really important, and it's something that can be done far more efficiently and effectively than splitting it up. It's a very low-cost form of future-proofing, for ensuring, for creating a much more stable and secure future than kind of splitting it up and consuming it, basically. So I'll just leave a couple of thoughts on what needs to be done. I can see in the US, and there's a good discussion happening here in Wyoming, and there's a very poor discussion happening in many other states, which we heard, is to really focus on the outcome, the purpose to which this sovereign wealth fund or this pool of capital has been put together. What is the purpose of it? That is the big people decision. That is the political decision. If the purpose is to act as a short-term stabilising fund, then say that and keep it there. One target, one stone. Don't try and hit two targets with one stone. If it's a stabilisation fund, that's what it is, and that then you can walk away and say, we will benchmark whoever's running that to that purpose. Are we achieving that outcome? If it's an intergenerational wealth transfer or a wealth transformation, which the permanent fund is, then be very clear about that and don't treat it like a stabilisation fund. And I think you have to have an honest and proper discussion. I'd kind of put a B-, how's that? I'll be outrageous, on the way in which people are thinking about it at the moment. To set up a permanent fund to turn that mineral into perpetual, ongoing wealth for all current and future generations, you don't take the earnings out of it every year, because that means you're actually consuming the earnings. You might as well just drink the oil or eat the coal or whichever, consume it. It's about growing wealth through time. And Malan's much smarter than me. He'll tell you about the wonders of compounding interest. So, an intergenerational wealth transfer is something that has to be set up with a very clear purpose. And then the politicians and the legislative people should leave the room. They've done their work. They've said, the people have said it's for current and all future generations, and that is enshrined in the Act. This is what we do in New Zealand. And then they leave me alone. We in New Zealand are able to, I have complete operational independence, I have complete goal dependence. I know our exact purpose, which is to smooth the future tax burden of ageing people in New Zealand, but then I'm left alone to get on with the job. In fact, we are so eager to have that operational independence, we have something called double arm's length distance from the stakeholder, the Minister of Finance. That person can appoint a nominating committee who then appoints the board, who I then report to. And there is never crossed lines. And then I'm getting on with it. In order to have operational independence, you have to have a clear purpose, you have to have clear measures of success over the horizons that matter, and you have to operate very transparently, and you have to invest without embarrassing the people. And so we invest without prejudice to New Zealand's reputation internationally. That involves setting up very clear governance, very clear accountability, and very clear reporting and transparency on the things that matter. So, if you could all shake your brains and liberate yourself and put your trust where it should be, and those who are the experts in going forward and creating the portfolios and managing the money, you will get true wealth creation without all of that distortion that happens too often on the east coast of this country around fees, confused timelines, misalignment between the owner of the capital and the manager of the capital, all of those dead weight costs of what is otherwise a very simple thing, being the owner of income-producing assets on the way through. So clarity on purpose, clarity on governance, and delegate and empower. Have the courage to empower. If you do that delegation right across your staff, a long-term investment fund, like the permanent fund, will add value that no Wall Street firm can recreate, because they can go places that others would not normally go, because others are worried about paying their bonus, they're worried about career risk, they're worried about reputational risk, they're worried about tracking error. Our fund isn't going up or down as good as the neighbour, and hence the money might leave and go to the neighbour each month. You know, the wash, the churn that goes on, especially in the US between mutual funds. All of that can be left behind, and you can become a very clear, responsible, long-term investor. And what does that mean? It means that you can go into particular markets that capital wouldn't normally get to. And who knows, some of those markets and some of those opportunities will probably be in your backyard. Don't force them to be in your backyard, because that's spending, that's not investing. But there may be opportunities around long-term capital growth in the region. In New Zealand, we have ended up with 15% of our fund actually invested within New Zealand. If I stuck to our purely passive index, we would have 0.15 of 1% in New Zealand. That is the capital weighting. So, but we have found fantastic long-term opportunities, fantastic returns, and all of the positive externalities that come with it by being singly focused on what is and isn't a good investment for our fund. So long-term investors, and what the permanent fund is and should be, and I would encourage far more autonomy and courage to happen. It has to happen. You know, stop electing people who say, "I'll save you 5 cents." You know, they aren't going to end up, they're not going to be the future Wyatt Earp. They're going to be some, you know, the accountants know the price of everything, the value of nothing. Enhance people to, you know, get on and create the wealth. And if you've got a lawyer in your investment committee, then get them out of there. By the way, I'm an economist, so they've been trying to get me out of the place for a long time. I'm an accountant without a personality. You know, the things that we've managed to achieve have been one of the lowest cost funds in the world, most cost effective, and one of the highest returning and value add funds in the world. Value add mean returns over and above what an otherwise simple passive index would achieve. And we've managed to put our stamp on what we do. We have clear environmental, clear social, clear governance standards that we uphold and always uphold, and if we partner with someone, they have to uphold those as well. Otherwise, we just don't bother. You know, as attractive as it is, you know, if you're not prepared to also marry them the next morning, then don't bother. So, you know, that's been pretty well what drives us. And I'll just finish, you know, the ones that we've managed to do, if you leave the politics in the room, then the current generation always wins, because the future generation has done nothing for us. And we will always have a more pressing demand. If you leave politicians in the room, then the current priority will always win. You have to have that autonomy and that courage. I would say that most of Wyoming's wealth has survived because it's still stuck under the ground. Imagine if you could have all just come and grabbed it, then none of you would have hit. It would have been long gone. It would have been on a train and well out of here. Well, I can't mention trains here, can I? So that's the key. Giving more autonomy to Mark and the team will also put a much bigger burden on their shoulders, the responsibility to retain the license to operate. And they will tell you what measures matter and how they're going to report against it. And over time, they will be the best contrarian investors in the world, you know, buying when others are selling, having fear when others have greed, all of that type of stuff. They will make Berkshire Hathaway sound like an old story. They will be selling insurance, not buying insurance, because they are long-term liquid providers. They will be going into private markets and investments that aren't normally seen anywhere else. So saddle up, show that courage, and really kick on with this permanent fund.
All right. So panelists, I just want to, you know, jump in, whoever. The way Adrian describes this, it seems like the funds, these sovereign wealth funds, are kind of is this part of a revolution, or how would you describe how important this is? And when you talk about long-term investing, we know there's such a dearth of it, and it's, you know, it's great if you're trading, but I had a nice talk with Mr. Hill earlier today from Hess about the short-term focus and kind of how it can wreak havoc with a company here at Gregory Hill, who's with, as I said, Hess. So what do you think? Do you want to add on? Is there anything you disagree with about how Adrian presents this, or?
I think to your first question about whether this is some sort of new revolution that's occurred, I don't actually think it is. the attention on sovereign wealth funds has increased exponentially since just before the global financial crisis, when Adrian and his friends were marched into the IMF's offices, and then during the crisis when they provided capital to a lot of under stress, particularly financial institutions. But the Texas Permanent Fund's been doing what they're doing essentially since 1860s. And the permanent funds in the States and Alaska since the 70s, Middle Eastern funds since the 70s. So there's been a growth in the size of funds under management by sovereign wealth funds and in the number of funds. But the concept is old and the concept is tried and tested.
If I may add to that, in fact, the world's first sovereign wealth fund was set up sometime in the 50s by one of the countries in the Middle East. Kuwait, okay. So it's not new. Now, what is new, however, is the fact that suddenly there's so many and they're so big. And whereas before, the sovereign wealth funds would typically simply invest in government bonds, and therefore they just basically disappear from the face of Earth. However, the new generation of sovereign wealth funds have started to make direct investments and also to make, use hedge funds, use alternative strategies, and co-invest with other investors. So that probably culminated in what Adrian was referring to, that meeting in Washington, when some of the wealth funds, they were really angry because they were saying, hey, listen, if they don't want our money, that's fine. Say it. Don't try and hide behind a cloak. We're just investors. And we don't need you guys to tell us what to do. Now, of course, they also need to understand that because they have suddenly just appeared on the horizon, and they are not just investing in their home countries, they are investing in host countries. So they also, and because they bear the brand name of their country, which is a sovereign, so they also need to understand the sensitivities and therefore work out some kind of a consensus so that people know where you're coming from and that you are there because you need certain things that need to be done, and you will do them with a good structure of corporate governance.
This end of the panel, anybody want to chime?
No, I really just can't add to what Malan and Alexis said because we don't feel it's revolutionary. I mean, it's interesting. We sort of avoided at all the term sovereign wealth fund. We were not a sovereign wealth fund. We were an asset of the state of Alaska, and we weren't an endowment either, and we weren't a pension fund. But there was a need to avoid the moniker sovereign wealth fund because there was this negative attachment. With the fading of that, we all can sort of stand up proudly and talk about what we're doing and that we're not making political investments, but rather economic, financial decisions. So,
Sam, as the professor here.
So I guess, these guys have covered the history about sovereign wealth funds well. I thought I'd just make a brief comment on one of the other points that Adrian made, which was around where should you invest this sovereign wealth fund. So Adrian mentioned that around 15% of New Zealand's fund is invested in New Zealand, but New Zealand's fund is specifically set up to manage pensions. Now in Wyoming, it's a completely different sort of thing. The idea in Wyoming is that you've got all this coal under the ground, right? And you're pulling it up above the ground, and the idea is you're just going to replace what's below the ground, the assets below the ground with assets above the ground. You don't want to spend it all in Wyoming straight away, because if you do that, then you'll be spending all this money very quickly, you'll overheat the economy, and things will all just get out of whack. The real idea of this sovereign wealth fund in Wyoming is to save it for future generations, so you spend it very smoothly over hundreds and hundreds of years. To do that, you really have to be saving it outside the borders of Wyoming, right? Because otherwise it will be overheating the Wyoming economy. So the default for Wyoming should really be focused on investing this fund in the other states of the US and also all around the world, which lets you diversify, which is not putting all your eggs in one basket, and it doesn't overheat the Wyoming economy.
Interesting. All righty. Well, let's continue on down this line of panelists tonight, and topics, I might add. Malan Rietveld is a director at Kalytix Partners. It's a consulting firm that looks at all kinds of issues that sovereign funds, pension funds, all kinds of funds have to deal with. He too has a very interesting background. He's was at the Investec, I should say, Institute. It's a client research team, but involved in asset management, emerging markets. So he has that hands-on market kind of knowledge of this whole area. I could go on and on. He's a fellow at the Center for International Development at the Harvard Kennedy School of Government and also at the Columbia's Sustainable Investment Center. And he's written 3 books on sovereign wealth funds. So, take it away, Malan.
Thank you very much. I'm going to mirror, I'm going to sort of echo a lot of what Adrian said, but I'll try and sort of build on from that. And, you know, what we've been talking about the past 2 days and what we always think about when we think about sovereign wealth funds is think about money coming in, think about money coming out, and think about what's in the box in the middle, which is how the funds are invested. And that's in large part of what Adrian spoke about and made the case for that box being sort of left to do its job and not getting people putting their hands into that box and telling the box where to go. So I'm going to talk a little bit more about the money in, money out aspect first and then come on to some other concepts. So, you know, sovereign wealth funds around the world are funded by a number of different sources, but the overwhelming share are funded by depleting and volatile commodity revenues. And so that's certainly the case in Wyoming and the case for most of the US state permanent funds. And you know, what Adrian drew attention to is this idea of saving for future generations, and the alternative function is to stabilize that volatile revenue source. And so that maps quite neatly into 2 different kinds of funds and 2 different kinds of structures. And it's really important from the investment perspective, from what happens in that box perspective, that you're clear about which are the 2 you're thinking about when you're talking about investment policy, because it's a very different kind of asset allocation. But I think it's really important as well as a public policy concept and as an accountable government concept that legislators, the executive, communicate this and educate the public on that distinction and why is the balance a certain way between those 2 and why is a certain fund the size. And as a general comment, I would say for US states whose budgets are still very much exposed to volatile commodity revenues, and Wyoming is certainly up there amongst the most exposed. Alaska, I'm sure Angela will share some thoughts around that, is the most exposed. But for those kinds of states, a general gut feel that I have is that the stabilization fund component is a little bit underserved. You need to have recourse to counter-cyclical assets that you can draw on if you're going through a budget crisis, and you need to be able to do that uncontroversially through the use of clearly defined rules. Because the danger is that you'll start doing, or there'll be pressure on you to start doing that from the permanent fund, from the long-term savings account, and then you're messing up the purpose of the fund, and it has implications for the asset allocation. So that's really important. That said, the permanent fund, as it is today, as that savings vehicle, is going to be absolutely critical to the future of Wyoming. You know, I cannot predict, and nobody can predict, where commodity prices are going next week, in a year's time, in 10 years' time. We don't know what the consumption of fossil fuels is going to look like in 20, 30 years' time. But as part of that uncertainty, it would be prudent, and it is prudent, for Wyoming to continue to do what it's done since the 1970s and transform that depleting asset into a permanent asset in the form of a financial portfolio. And it'll be, fiscal pressures will bite. It will bite due to cyclical issues right now in commodity prices and commodity production. So it's really important that you don't blow the good work of the past 30 years in terms of building that portfolio and continue to grow that portfolio, because you're going to need that asset and you're going to need that income for years to come. You know, finally, I'll just sort of come back to the points that Adrian made around empowering the box, the team that's making the investments. And, you know, frankly speaking, the US, and it's not just a permanent fund, and it's certainly not just Wyoming, it's pretty much across the board in institutional investment, particularly public sector investment, public pensions, public endowments, permanent funds, is sort of lagging behind the rest of the world in terms of empowering independent, professional asset management competence. And there's a number of reasons of that. It won't be solved overnight. It takes a long time to build a competent investment team, but it can be done. It is, as Adrian said, it is cost effective. Don't save those pennies when you could be making dollars by building up a competent investment team. You'll save, in the long run, massive amount of money by not just outsourcing fees to external managers. And that's, Adrian spoke about compounding, but people often forget about fees. They say, oh, well, fees, what difference does it really make if you pay 1% or 2% in fees? But in this low return environment, 1%, and go compound that 1% over 10, 15 years, on your permanent fund endowment, could make the difference between your permanent fund being $30 billion in 10 years' time and being $40 billion. The effective compound interest is so strong, which is, my final point would be, on that final component of money coming out, you have to really be careful in Wyoming. Your saving side, money going in, is pretty well done because it's in your constitution. So I don't see mistakes there, and I think that's why you have this permanent fund that's pretty sizable. But on the spending side, you need to withdraw a prudent amount of money that doesn't deplete the fund. And there's some work there as well, I think, in Wyoming in clarifying exactly the right principle. It's solid endowment principle is to draw 4% or maybe 5%, which is sort of equivalent to the fund's long-run real return potential. But you could also spend just what you've made in the last 5 years. But I think there's some work to be done around whether you include capital gains in that. That's sort of a strange concept, and it causes all kinds of accounting problems. I think there's some work to be done to draw that spending amount, particularly in the case of Wyoming, to something that's more sustainable and helps you maintain and grow that fund over the next few decades.
I want to ask you a question, Malan, because you consult with all kinds of people, right? And when you say that you're urging funds to build up a strong investment committee, well, I assume part of that is paying people, right? And do you think, or does anybody think that part of the problem is that if it's a state or federal government-run fund, that there's a sense of we have layers of people, and you reach a certain level, and that you make a certain pay grade, and you have a certain kind of job, and if you were to have something where you compensated people more, that you would somehow get in the way, or is it kind of like, if it's local, then it can't be that good? I mean, how could you compete with those fancy guys and women who, work for Goldman Sachs? So obviously they're worth the fees. And how could you possibly, you just went to that state college and here, why do you think that happens?
Yeah, so what you pointed on, what you touched on is exactly the issue. It's not the only issue that's constraining the development of in-state sort of internal investment capacity, but it's a very important one, and pay scales is one. For many state investment institutions, there's all kinds of bureaucratic procedures that need to be done to just make simple operational appointments, which is really sort of an outdated way of doing this. And I think it passed when the permanent funds were small, and you're just sort of getting the basics right. But you're in the big leagues. You're in the big leagues now in terms of asset management, and the permanent fund is a big part of your state's fiscal future, so it's worth making that investment. So certainly pay scales. The issue of geography is important to sort of geographically isolated states like Alaska and Wyoming, but there is no reason why you can't identify and cultivate homegrown talent, and where applicable, I think states should have an open mind to setting up sort of satellite offices. It could be sort of asset class specific offices. Based in somewhere that's nearby. It could be Chicago, it could be on the West Coast, and they could be in regular contact with the home office. But there's a ways to go. I mean, I'll be frank about it. It seems to me like a very long way to go. But every journey starts with the first step, so it's important that these issues get addressed, because you're paying for it anyway. You're paying much more for it by using external people.
Just to put it in simple perspective, from our fund in New Zealand, by the way, the website tells you everything about our fund. We are extremely transparent, so you can work out what it is later. But when I inherited the role, we were paying 1.1%, I think 110 basis points or thereabouts, per annum to manage the fund. We now pay less than 0.4, 40 basis points, to manage the fund. We've gone from 17 staff to 115 staff. We are able to attract, retain, motivate people very easily because they can get a global job but be where they want to actually live. And looking around here, apart from the smoke, I don't think you are going to have a problem. I don't think you're going to have a problem attracting, retaining, motivating talent who wants a global job, who want to bring up a family in a part of the world that they want to live in, who may have even come from the state originally. It's critical. But the only way it will happen is if you don't have to jump through and explain every time you want to appoint one more person. When our fund was originally set up, we had that annual appropriation challenge. We had to go back to Parliament each year and say, I need 3 sandwiches, 2 cheese, 1 ham, please. Feed. After about year 3, they took the good fight and said, let's feed ourselves out of our own fund, and we will be held accountable and we will be transparent against the global best measures of cost effectiveness and value add. And that is so empowering to a staff to just get on and do it. And if it's too volatile for your balance sheet, take it off the balance sheet.
There you go. Anybody else? Alexa, go ahead, sure.
Right. Now, even if you hire outside external advisors, you will still need very good internal people, because the advisors can only advise you after you have defined for them how you want your money invested, what is your risk tolerance. That's very important. And unless you are able to define that, the advisors, you would not be able to get the best service out of your advisor. So it's good, it will be good for you to build up your own internal team. And at the end of the day, this is the team that you can trust. This is the team that will go with you into your war room when you have a crisis. And you can talk to them, and together you can strategize what you need to do before you even go out to tell your advisors how you want your trades or your investments to be executed.
Any other thoughts? All right. Well, then just don't put down that mic, Alexa Lamb, because you're next. You're on tap. Now,
Okay.
she's a professor of legal practice, Faculty of Law, University of Hong Kong, Faculty of Law, Hong Kong University. She was Deputy CEO of the Hong Kong Securities and Futures Commission. She's done so much. She has, she promoted actively financial cooperation between the mainland and Hong Kong on capital market opening, reform policies, cross-border innovations, principal architect of the development of Hong Kong's offshore renminbi business. And she's securities, the markets, she's practiced it, and I think that the University of Hong Kong is very lucky to have her teaching there now and bringing the students all of her expertise and knowledge.
Thank you, Kathleen, for those very nice words. Now, I am in complete agreement with what Adrian and Malan have just said. But what I'd like to do is to get a little more granular. So I will quote you, or I'll draw for you 2 examples of sovereign wealth funds and how they're used and what they're used for. The long and short of it is, as a government or as a state, the most important thing is you are very clear what is the purpose of your fund. And even more importantly, you articulate this very clearly to the public, because that's very important. Because when the day comes that you need to use the fund, you will need to justify it. And therefore, the fact that you have articulated it clearly will help you. So the first example is Hong Kong, 1997 Asian financial crisis. The Thai baht fell, the Indonesian rupiah fell, the Korean won, the South Korean won fell, and then the hedge funds came to Hong Kong. They wanted to break the Hong Kong dollar because Hong Kong was next. And earlier in that decade, George Soros had actually broken the pound in 1992. So if the pound could be broken, the little Hong Kong dollar, piece, is a cakewalk. So they came in. And the government, what they did was they mobilized the exchange fund to fight the hedge funds. Now in Hong Kong, we have an exchange fund, which as a sovereign wealth fund is probably unique in its purpose because it's not for intergenerational wealth preservation and transfer. It's not really for stabilization, but it's to protect the currency because the currency, the Hong Kong dollar is pegged to the US dollar. So you need to back it up in case people come and ramp it. So for every Hong Kong dollar that is issued, there is sufficient backing in the exchange fund. And the purpose of the fund is set out very clearly in the legislation. It is to be used by the financial secretary as he sees fit in order to protect the value of the dollar and also to preserve the stability of the monetary system. So the financial secretary called the Hong Kong MA and called around a whole bunch of brokers, and they started operation for 2 weeks. And eventually, they prevailed. The hedge funds went away, and the Hong Kong dollar was saved. Now, at that time, there was a lot of controversy. Should you do that? Are you allowed? Should you be playing in the market? There's no more free market because you're intervening. And by the way, who says you can use the money? Now, then the government just pointed to the legislation. Hey, guys, it's written here very clearly. And as a government, we are here to protect and serve Hong Kong and the interests of Hong Kong. And if the Hong Kong dollar were to go, every one of us here would suffer. Look at Indonesia. Look at Korea. They are now suffering under an austerity program dictated by the IMF. Now, is this what you want? Everybody, oh, okay, thank you. So Hong Kong was safe, but the moral of the story is, one, it was good that we had the fund, but even more importantly, it was good that the purpose of the fund was clearly articulated. Now, the government actually exercises strict discipline in terms of the fund. It doesn't dip into the fund for any special projects or because of any particular political pressure. Now, if there are special projects, the government will go to the legislature and put in a budget, put it in the annual budget and ask for allocation of funds. But that fund is strictly preserved for its own purpose. Now, in terms of the investment, the principles are also made very clear. Notwithstanding the fact that it is only to preserve the stability of the system, it is, however, to be managed such that it will preserve the long-term purchasing power of the assets. I think that's very important. So you want to make sure that you preserve it against inflation, because even if you don't dip into the principle, if you don't beat inflation, it will eat into your principle. It's as simple as that. So that's the Hong Kong experience. Now, Singapore does it a little differently. Singapore actually has 2 sovereign wealth funds. One is managed by an outside company, the GIC, and that fund manages the official reserves. The reserves and also the foreign exchange reserves of the government of Singapore is managed by the GIC. But what I'd like to talk to you about is the other sovereign wealth fund, which is called Temasek. Temasek is actually a corporation incorporated in Singapore, so it's an independent entity, independent of the government. It actually owns its own assets. And it got the assets were injected into Temasek on the day that it was formed. And the assets were the corporations that the British government left behind for the Singapore government when the British left Singapore. So those were like young, budging young corporations. And the government at that time decided to give it all away to an independent company to manage so that the government could get on with its own business of developing the economy and the trade and the finance part of Singapore. So Temasek was given this portfolio of companies, and they groomed it. And today, some of the names are like global names like Singapore Airlines, Singtel, DBS Bank. So these are the companies. Now, however, Temasek's purpose is very interesting. It doesn't say that it's to preserve or protect or whatever it is. It says it is a generational investor. It invests for the future, for a better future. And it invests to make economies better and to promote a larger middle class. Now that's very important, because that actually tells you that it is different from, say, the funds that Adrian was talking about. Because those intergenerational funds and those stability funds, they would be done by GIC, right, as part of the government's reserves. But this is a very strategic fund, but they use it to not just develop Singapore, but also help develop neighboring countries under the philosophy, which I think is very wise, and that is, in order for Singapore to be able to protect its wealth and maintain its wealth, it is important that her neighbors are also wealthy. And therefore, they want to promote a larger middle class in the region. So they invested not just in Singapore, but in China, in Hong Kong, in Korea, in Taiwan, and also in other countries outside Asia, but primarily in Asia. Now, one project that they are doing now, which I think is most interesting, and that is they are now renewing the Mandai Rainforest Park. Apparently, this is Singapore, as you know, is a huge rainforest. It's right on the equator. This is a rainforest park that has fallen into complete disrepair, and nobody knew what to do with it. Now, Temasek took over the project and decided that it will completely renew the entire park. The purpose? They say it is for the future generations of Singaporeans so that they get to appreciate and understand their natural and cultural heritage. So I think the story here is, if your fund's purpose is for development of your community, say for instance, I understand that you have a rainy day fund and you don't really have a specific purpose as to what it should be used for, you may want to consider whether or not you want to clarify the purpose of that fund and use it for purposes of promoting future generations of Wyoming residents. Because, you know, again, the moral of the story is, if the purpose of the fund is to do a particular thing, then you should have the courage and the conviction to do it when the time arises. And this is what the Temasek is doing. Now, why is Temasek doing it and not the Singapore government? This is because this is actually a project that can bring remuneration. It can bring return, but it has to be long-term. Temasek says it will be a 20-year project. But they say they are not investing for today, not for 5 years, not even for 10 years. They're looking at a span of 20 years, maybe beyond, but it doesn't matter because it is for future generations to come.
Well, and I think this raises a very interesting point to me about, certainly, I think when you think about federal government policy, in any country probably, you know, create jobs, you want all these good things to happen from what the government does, right? And I think it seems that it doesn't always seem to work that well, right? And we can train people for jobs, but actually if we could, or we want to stimulate the economy, and we could get into a hole, we could spend all night talking about the Fed trying to do so much, and where are they now? That's another conference and panel. That's this week, actually, in Jackson Hole, in the Lodge. But I want everybody it seems like then this is potentially, if you could have that kind of success, this seems potentially very powerful when you have, rather than I don't know how to describe it, but a department of people who are trained in one thing, but you have someone who is going to target investments that they see as potentially very lucrative and powerful, that this is another way that sovereign wealth funds, they've been around for a long time, but they could really have a role that needs to be played in a lot of countries. Go ahead, Sam.
So again, this is banging on about the message that I was talking about before. I think really the priority of the fund should be diversifying outside the country's borders, right? To invest too much of the fund domestically it runs a real risk of overheating the economy, especially when the money is coming from commodities like coal that are so temporary. The only reason why you might want to think about investing in the domestic economy is if there's some sort of failure of the market. You've got to ask yourself, why isn't someone else doing this already? Right? Why isn't the private market already stepping in and doing this? It could be the case in Singapore that maybe no one in the private sector has a long enough time horizon that they're willing to invest so that they'll only make their money back over 20 years. If that's the case, then sure, make the investment. But really the default should be keeping the money outside the country's borders. If not, you run the risk of what they talk about in Norway, which is building a bridge over every fjord, right? It's just so easy to jump into this money and start spending it willy-nilly, and you start getting things that just aren't, giving too much, enough of a payoff. So you really have to ask, what's the market failure? Why isn't someone doing it already?
I would take a slightly less pure view. By the way, 10 years ago I would have taken that pure view, but I've been unlearning my economics because all models are wrong, some are useful. Building that capability, I mean, I totally agree. What Alexa's saying is people are very short term. I know I eat too much, I drink too much, I should do more exercise. I know all of this. It's not like oh my God, I didn't realise that. But I'm not doing anything about it. We are useless. What we're trying to do here is capture capital for long-term wealth creation. And so you effectively have to override all of the myopia, short-termism, fear of failure, tracking, all that stuff that is embedded deeply in the human psyche, and create structures that can advantage from those deeply embedded behaviours rather than fall prey to them. And that is what a lot of effectively we're trying to model the ideal investor. Well, in other words, if the money is left in a treasury, the accountants will get it and they'll tell you about the price of everything. If the money is left with the government, well, my project is absolutely more critical and important than the next one. If it's left with the current generation, well, yee-haw, let's party. These are just realities. So you've got to be able to institutionalise as best as you can within the democratic framework. The outcomes are democratically agreed, but then engineer and institutionalise the best behaviour. And once you get that going, it becomes incredibly self-fulfilling. We now present, for example, our monthly returns to the public. The public now see that as just noise. In fact, I'm now having journalists, I know you're sitting, I didn't want you to fall over, journalists saying when the market falls, they're actually saying to me, Adrian, that must be an opportunity for our fund. 5 years ago, they were saying, you muppet, what have you done this time? 11 out of every 12 falls I get called and used to be abused, and now they're saying, awesome, let's get in, this must be great. So it's about putting that institutional structure embedded, which Singapore have done well with Temasek, HKMA so well with the Monetary Authority, and increasingly with the global sovereign wealth funds that are being formed. It's simply about trying to hardwire behaviours that optimise through time rather than optimise our current consumption.
Adrian, that's truly impressive. You've turned New Zealand journalists into value investors when Cal Pers couldn't do it. So You should all just hire Adrian to come run your portfolio. Or Kiwi journalists, yeah. We run the slight risk here of just agreeing with everything we're saying. So I'm going to take an issue with a small thing that Adrian said. So he said, if you leave it to the current generation, you say, yeah, we'll party and we'll spend it. My view on this is starting to change because I see, frankly, an astonishing number of cases where people have implicitly, through their support and pride and sometimes anger when the fund gets raided, demonstrated their support for savings. I mean, the most obvious example that I can think is north of the border in the Canadian province of Alberta, where they had something very similar to your trust fund, financed by the oil proceeds and the tar sands, that in the 1980s did a terrible job investing in political pet projects, giving concessional loans and things to connected industries, and it really did a terrible job. And by 1994, this was very evident to everybody, to the point where they thought maybe we just unravel this fund and sort of spend it down. And before they did that, thankfully they sent out a very sort of detailed public questionnaire, and it was titled, Can we interest you in an $11 billion question, which I think sort of gets people's attention. But the options were, do you want us to run this fund down? Do you want us to keep investing in Alberta? Or do you want us to turn this into a savings pot that spits out some money to help finance the budget and reduce your tax burden? And 80% of people voted for that last option, and that's what the Alberta Heritage Fund has been largely doing since then. And I can tell the same story about countries you would never expected. Trinidad and Tobago, a poor country with massive development needs, and they should be investing in infrastructure to raise their growth potential. But there's still support for the savings fund. And one thing that gets people really angry is if people draw down willy-nilly on a savings fund. That's how to make your population really angry. So my view started changing on this. I think people have the ability to vote for savings, and maybe it's because they've seen what governments do with resource revenue windfalls in the past. It's not really a happy history.
Just a very quick response back. I completely agree. Get started, make it worthwhile and important, and then get people interested. And that's the way it becomes self-sustaining. If it becomes just some mythical concept sitting somewhere blurred in a treasury budget, then it just becomes annual consumption. Put it out there, shine the light on it, give the keys over to people responsible, hold them accountable, and suddenly everyone's involved.
All right. Well, Angela Rodell takes the microphone next. She is the CEO and Executive Director of the Alaska Permanent Fund Corporation. It's a state-owned corporation based in Juneau, Alaska, that manages and invests the assets of $53 billion in the Alaska Permanent Fund and several other funds by law. She's also served on the AFPC Board of Trustees as a cabinet member. She has a long history with finance, I should say, and of course she's in a very interesting state when it comes to funds and mineral resources like oil, and having some unique programs that the state of Alaska has had for its citizens for many, many years.
Thank you for including us in this discussion, and Treasurer Gordon, it's been fantastic to actually be at one of these forums talking about our role and what we should be doing and how we should be thinking about some of these things, rather than all too often I think we go to these and it gets into should we be in private equity or not. And so it's really an interesting time in Alaska. I thought what I would do is similar to Alexa, is sort of really drill down and explain our story in Alaska, because it is a unique story, and it sort of has little components of the other case studies you've heard about tonight. So Alaska became a state in 1959. When we became a state, part of the agreement with the federal government is that we would figure out a way to support ourselves, right? And Alaska had a history of sort of these boom commodity drives, whether it was fur, whether it was fish, timber, gold. I mean, I think all of us know about the Klondike, right? So there's been this history of sort of boom, really going after the resources, depleting them, and coming back. 1969, 10 years later, oil is discovered up on the North Slope of Alaska in Prudhoe Bay. And the lease sales that occurred as a result of that generated $900 million. That year, the fiscal year 70 budget was $173 million. Now, we were a young state. There was a lot of needs. There was a lot of demand on that money, and it got spent. Woohoo, to Adrian's point. And they looked around and went, wait a minute, whoa, what happens when this is gone? So in 1976, in November of 1976, it'll be 40 years this November, the people of Alaska, by a vote of 2-1, so there were people opposed to the creation of a savings account, created constitutionally the Alaska Permanent Fund. And the Alaska Permanent Fund gets 25% of the mineral royalties and lease payments. It is not entitled to any tax revenues that are generated or any other related payments, and it's just this small portion. The first deposit happened in 1977, and it was $796,000. So we go from there, and how do we end up with $53 billion in 2016, 40 years later? Well, we've deposited more than $18 billion over the years in terms of royalties and other monies that the legislature decided it was important to put money back. So when there was a wealth, there was extra money. At times, the legislature did appropriate money into the corpus of the fund. I think the other thing that you should note is that the constitutional amendment required that the fund be invested in income-producing investments, the principle of which is not to be touched. The income shall go to the general fund or other funds as designated by statute. So the deposits are going into, rather than the general fund, we put them into a fund that was created called the Earnings Reserve Account, but I get ahead of myself. So come forward a little farther, 1980, the legislature created what we affectionately call the dividend program. They created at the same time the Alaska Permanent Fund Corporation to manage the assets of the fund. And they also created the dividend program, which is not administered by the corporation. The corporation has a very simple, very straightforward mission, and that is to manage the assets of the fund. The dividend is an interesting program because we talk about, as the other panelists have talked about, sort of this economic drivers, investing, and there's been a lot of debate in Alaska. Should we be investing in Alaska? And I say to them, we have invested in Alaska. We have invested to the tune of $23 billion. That's the total amount we have paid out in dividends since the program was created 35 years ago. That $23 billion has gone back to individuals, every man, woman, and child in the state of Alaska. It has funded college educations. It has funded small businesses. It has funded business consumer spending in those small businesses. It has paid for vacations. It's one of the things that we all enjoy about the dividend is, what are you going to do with yours this year? What are your plans? Oh, I think I might save it. It goes to a tremendous number of charities. A program was started a few years ago where you could, called Pick, Click, and Give, and when you filled out your dividend application, you could click to have that money directed to the charity in Alaska of your choice, rather than taking the check yourself. So over $2.5 million each year out of the dividend goes directly into some of the charitable causes around Alaska. So it's created a really sort of interesting impact on the state of Alaska. We are, similar to Wyoming, we're having a tough time right now. Those oil prices are killing us, right? And we are very dependent, our state budget is very dependent. And so the debate is happening again. What do we mean by future generations of Alaskans? Are we investing to serve Alaskans through the dividend program and to make sure that the wealth, the renewable resource that we have created out of a non-renewable resource continues to be there for every man, woman, and children, for my children, my grandchildren, my great-grandchildren, and their families? Or Is it defined as, let's put it into education and educating those future generations of Alaskans, or into some other program? And it's a really tough debate. And as I like to say, it's my job to manage the money. That's what I get to do. It's our policy makers that have to redefine and redebate the issues in Alaska. One of the other things I wanted to talk about, because I didn't speak up on purpose because I wanted to cover this in my own remarks, is about this notion of internal investing and the value add. And there's been a lot of discussion about, should we, shouldn't we? And I'm required, every year, our Board of Trustees puts together a budget proposal. That budget proposal then is sent to the governor, and the governor has the ability to make changes to that budget and include it, and it is then included in their budget proposal to the legislature. And then, of course, the legislature likes to debate every appropriation, including ours, and as to whether or not we're spending the money wisely. And so I get asked a lot about whether or not we're adding value to the fund. And so I just want to sort of point out a couple of things to sort of illustrate some of the things that have been already discussed up here. If we look at the last 5 years, 2011 to 2016, and had we invested the permanent fund in a passive index, 60% global stock, 30% global bonds, fixed income, 10% real estate. Basically an asset allocation that could be generated by a computer and hit. The return on that portfolio for the last 5 years would have been roughly about 4.9%. We returned in excess of 6%. It's a difference of about 1.3%, which equates to $3 billion. So by having the entity that is the corporation, we generated $3 billion in additional value that could not have been generated. And not only did we create that additional value, we kept good paying jobs in Alaska by doing that. The second thing I want to point out goes to sort of the talk about fees. We have 43 staff in Juneau. We don't have offices anywhere else in the world or anywhere else in the United States. Not even in Alaska. Boy, is that a debate. I could probably put an office in Seattle before I could put one in Anchorage, let me tell you. It's really, I have 18 investment staff, including my chief investment officer. And one of the areas that we have internally managed for a long time has been our direct real estate portfolio. And the direct portion, not including the REITs and some of the other pieces, is roughly $3.5 billion is the current value of that asset allocation. I have 4 individuals that work on that direct portfolio. They cost, just those 4, they cost $83,000 in salary and benefits a month. So roughly $1 million a year. I could take that 3.3 billion and I could put it in a 30-year treasury bond, right? Mm-hmm. Because that's sort of the time horizon. 30-year treasury bonds today, if I bought and held, have a coupon of 2.5%. So not getting into the yield or any of that other stuff. Just what is the coupon income coming off of that? Would generate about $6.9 million a month. The income generated off our $3.3 billion real estate portfolio is roughly $26 million. I think the investment in those 4 individuals at $83,000 and generating $16 million over and above what a passive investment would do, more than pays for itself. And so what I want to stress to you is that there is real value in this. These are not just high-paid state workers. And there's a lot of pushback. I get a lot of pushback of, I'm trying to grow state government. And I'm trying to create high-paid state workers. And I shouldn't be creating incentive, we don't have an incentive compensation scheme. But in an area of fiscal tightening, when we have really tight budgets, and everybody's state and worker, each department is having to really examine into those programs, about whether or not they need to cut the workforce, and the debates with the unions about cutting state employment, and I'm coming in and I'm having to explain why I need yet another $200,000 job. So it's a tough conversation to have. And that's why I want to stress to you in Wyoming the real value, though, and that not everything is equal. And to sort of recognize the nuances and the expertise and how important that is to the value of the future of these funds. Because you know what? Nobody cares more about the Alaska Permanent Fund than Alaskans. And nobody is going to take care of it. I promise you, Wall Street, as good as it is, they do not care about the Alaska Permanent Fund like Alaskans do. And it's true with Wyoming's fund. And so with that, I'll open it up to any
Other
questions
comments,
you might
because
have.
this makes me think what Alexa was talking about, like who's going to go in the war room with you. You know, Adrian, you touched on this. It's very powerful. I mean, but it's easy to understand, right? It's like, oh, how could you pay someone so much money? And it seems to be the answer is so easy, but look how much money they made, multiples of what we paid them. But maybe part of the problem is people, I don't know, but is there an economic theory for this? Is there?
There is. It's just incentivization. If I'm paid with a 10-year horizon, I will behave to that 10-year horizon. If I'm paid to a 1-year horizon, I will optimise things over a 1-year horizon. Corporates and asset managers can be incredibly short-term because of a whole lot of incentives that you cannot recreate unless you recreate it internally. You know, ours is a 30-plus year intergenerational fund. We then do a 5-year strategic plan. I'm then told to have an annual report. I'm then told to update it quarterly onto how we're tracking. And then I have a monthly return, and then I have to do real-time disclosures. So where is my head as CEO? I'm like this. So you have to override that behaviour, and you have to get the incentive structures right for your staff to be able to really reach out, you know, into those long-term, proper value-creating investments rather than short-term trading. It is a very different mindset.
I just want to comment on something Adrian said. It's sort of off the topic that we started with here, but it's I'd raise it to Angela and Adrian as practitioners. Is whether, you know, you're long-term investors and you need to be incentivized, you need to be assessed on the long-term performance. Now, Adrian runs, as far as I'm concerned, the world's most transparent fund. You know, the Norwegians have a split-second indicator of how much money they're managing. The thing ticks over like that. But in a broad-based sense, I think New Zealand's the world's most transparent. But do you, as practitioners, feel that some of this is a little bit excessive? You know, you've said you've educated the journalists on buying low and selling high, but you know, do you feel there's a risk that you're sort of overexposed and that particularly that your reporting framework is too short term? And I'll ask that to Angela as well, I guess.
Is the reporting, word that again for me, Malan, is the reporting structure too?
Yeah, your frequency of reporting, does it hamper your ability to be a long-term investor?
No. And I think, you know, and it's sort of an interesting, you know, can you ever be too transparent or report too much? And there is a tension. I mean, there is definitely a tension, and to the extent that there are too many hands or too many hoops to jump through, certain investments will not come your way because especially in private markets, that they don't want, especially, so let's take venture capital. There's tremendous opportunities in venture capital. It's a tough space to be in. Not everybody is successful in their venture capital investing, but part of the idea behind venture capital is somebody has an idea and they think they can make money off that idea. If I have to talk about it in a public meeting, guess what? You have access to that idea now. And they lose that sort of ability to have market, you know, be opportunistic on the market. So I think how we view transparency is it's very important for us to talk about that we want to invest in venture capital. And we talk about what we invest, that we invest in venture capital and that we've made returns off of venture capital. But I won't talk to you about who specifically or what ideas we invest in, because it's important. And the good thing is when our statutes were created, they put in place the confidentiality requirements to allow us to protect that from the FOIA, the public access to that extent. So it is a balance, but I think because private markets are becoming so much more important to our portfolio performance, that it's even more important for us to be out talking, because that's how we find out about deals and deal flows and interesting things happening around the world, by talking with each other, by hearing where we think opportunities and where those market dislocations. And what's fascinating to me in this role is talking to somebody like Adrian and what he might think is a market dislocation, and we sit back and go, yeah, no, I'm not seeing it. And getting that sort of intellectual insight into, because we're all in different parts of the world. And it's just, it's fascinating to have that, to be able to have those kinds of conversations.
I'll just make short and what I'm specialised at, simple comment that, which I made earlier. What gets measured gets managed. So it's critical that you measure the right things and communicate to those measures all of the time. While we are highly transparent, we are very controlled about how we are transparent. So we truly talk about long-run moving performance. We exactly highlight our ongoing value add compared to a simple passive listed reference portfolio. And we put it over the strategies, over the horizons that matter to talk about those strategies. So whilst we monthly produce our performance results, that is purely a treasury function. It has to be done for the government's accounts. Real time, that's just noise, isn't it? It's a comedy show, you know, Norway with this thing spinning around. It's totally vacuous. You know, what on earth are we trying to take from that other than there's more zeros than the rest of the world added together? You know, you've got to be transparent around our purpose is this. We are getting closer to the goal by this much by doing this. And just be monotonous about that purpose. And that provides you that space. For us, what we have to be very transparent about is our responsible investing activity, our environmental, societal governance principles and how we are upholding to it. And I think that is coming rapidly towards the US, and I think you're going to have to get ready for it. One big challenge is climate change. It is real. You're sitting with resources whose lifetimes, economic lifetimes may be a lot shorter than what was originally planned, because they may be regulated, they may be excluded from people's portfolios, the pricing of carbon will change, and a whole lot of other true events are happening, whether you strip the coal up out of the ground or leave it in the ground. So you're just going to have to do some smart thinking.
Okay, I'd just like to follow up on the point that Angela made about the difficulties with staffing and with paying them properly. Now, governments and civil service don't look at functions, they look at headcounts, and they have salary bands, and therefore we have problems. So what Hong Kong and Singapore have done is to say, okay, we understand all of that, but first of all, this corporation, for instance, Hong Kong MA, Hong Kong Monetary Authority, or the Securities Commission, or for that matter, the Exchange Fund, they are independent entities. So they are not within the civil service, although they are part of the larger government. And since they are not within the civil service, they are not bound by the same rules with respect to salary bands. So instead, what they do is that they hire consultants to look at market pay, and they benchmark themselves against the median quartile, whatever you call it, like 50% or whatever. So at least they get good people, and clearly they can't pay as much as the market, but they have to reward these people with what they call interesting work and rewarding experience. That's what my chairman told me when he tried to persuade me to join the Securities Commission. He said, Alexa, I promise you, the work that you get to do is work that you will never, ever get to touch in private practice. And that's true, because I was given the world stage to work with China to open their renminbi market. And that's something you would never be able to do in private practice. So Angela, you may want to think along those lines. And I think the Wyoming people should also think along those lines, because you pay peanuts, you get monkeys.
Oh, I'm going to remember that one.
And just to clarify, that is where most sovereign wealth funds have gone. This is exactly what we do. You benchmark regionally. You don't benchmark against Wall Street. That's what the Canadians have convinced each other to do, haven't they, successfully. You benchmark against local market conditions, Australasia for us, and you pay up for them. But they still end up well south of the gratuitous types of salaries that you might hear.
Okay, well, here we go. Professor Wills, Samuel Wills, is our final panelist of the evening. He is ESRC Future Research Leaders Fellow in Economics at the University of Oxford. He's a macro and financial economist. He looks at how countries can better manage their natural resource wealth. So he's perfect for this this conference we've been at for the last couple of days. He is won a lot of awards as an economist. And he has worked, again, not just in academia, but everyone from, World Bank on natural resource policy in Iraq, Libya, Uganda, worked with the IMF, the Bank of England, so many more. So he's had, for a young man, he's had all kinds of experience. And Professor Wills is going to give us now kind of a step back and give us kind of a big picture view of some of the issues and dynamics that are so important in the sovereign wealth fund industry.
Exactly, and so what a fantastic panel we've had so far, right? Such a fantastic set of insights from people running some of the best managed funds in the world, from New Zealand to Alaska, insights from Singapore and Hong Kong. And so what I thought I'd do is build on these sort of deeper insights, zoom out a little bit, and we'll share some of the latest thinking from research over the last decade or so on how academics think that these natural resource funds should be managed. And so I guess to start things off, let's just start at the start, right? What exactly is a sovereign wealth fund? Well, a sovereign wealth fund is just basically a big bank account that the government has to save on behalf of its people. And just like your own bank accounts, there are a whole bunch of different purposes why you might have one of these sovereign wealth funds. You might be saving for pensions, just like you save for your own retirement. You might win the lottery and want to save some money so that rather than spending it all on sports cars and flashy houses, you save it for the future, turning new money into old money. And that's really the sort of situation you're in when you discover coal. It's like winning the lottery, and what Wyoming is doing is transforming this short-term boom into longer-term prosperity. Now you might ask me though, look Sam, we've got about 400 years worth of coal under the ground. Why do we even need to worry about smoothing this stuff out? Like, you'll be dead, we'll be dead. We've got more money than we know what to do with. Why should we be thinking about future generations when they've just got just as much coal? Well, I guess Adrian touched on it a little bit earlier, which is that this old adage that the Stone Age didn't end for lack of stones. And it could well be the same with Wyoming's coal. So there was a bit of research done by a bunch of guys in London in the last couple of years, which showed that if the world is going to keep to 2 degrees Celsius global warming, then 60 to 80% of its natural resource wealth can never be burned. 60 to 80% of all the coal and the oil that is on the books of publicly listed companies can never be pulled out of the ground. Now, I'll leave it up to you to think about whether or not you agree with the climate change policy or whether or not you think we're actually going to hit that target. But it's an interesting thing to think that these two things are mutually exclusive. You can't burn all the coal that we have under the ground as well as keeping global warming to 2 degrees. And so it sort of makes sense to start thinking now about how you might manage that risk in the future. So what I thought I'd do over the next few minutes is share, we'll basically make three main points. 3 main points that have come out of research over the last decade or so. The first is that developed economies, like Wyoming, should set up 2 sets of funds. a future generations fund, which is to save the money for your grandchildren, your great-great-great-great-grandchildren, that sort of thing. And the second fund should be a stabilisation fund that helps smooth all the shocks that come from really volatile commodity prices. But as I made the point earlier on, these two funds really should be focused outside your own borders, so in the rest of the US or around the world. The second point I'd like to make is around this Future Generations Fund, the one that's focused on your great-grandkids. The first point to make is that you've got to think about not putting all your eggs in one basket, right? You want to diversify away, which helps spread your risk around. But you've also got to take into account the fact that you've got a whole bunch of oil underneath the ground when you're thinking about what to invest in above the ground. So you want to sort of diversify away from oil. The second aspect of these future generation funds is that you want to kind of spend a stable amount over time, right? And what this means is that as that fund is going to get bigger and bigger and bigger and bigger, as you pull the coal out of the ground, you're going to have to start spending less and less of it to stabilise your spending over time. And both of these things are actually quite different to what's being done at the moment, and they're sort of new contributions to sort of academic thought. The third point is around these stabilisation funds. These are the ones that you use to offset all that volatility that comes from commodity prices moving around. We find that these things are super important in places like Wyoming because you don't have access to that other big lever of controlling the economy, which is independent monetary policy. Wyoming doesn't set its own interest rates, it's set by the Fed. So in that case, you really got to rely on smoothing government spending because you won't have interest rates to smooth things out for you. And the other thing to note is that if you're going to be running down the stabilisation during the bad times, you want to build it back up again in the good times. So you want to run a balanced budget over the cycle. So let's dive right in. So the first point to make is that we want to be saving these funds offshore. We know that natural resources lead to, or have the potential to curse the countries that discover them. And the little island of Nauru that I grew up on is a fantastic example of that. It's been completely destroyed by terribly managing its natural resources. We identified about 7 different ways in which these resources can challenge the way that you manage them, right? They can cause problems. Almost all of them are fixed if you're saving this stuff abroad. You get far fewer benefits if you're investing it at home. For example, one problem is inflation. So if you're going to spend all your coal money straight away, you're going to overheat the economy. Prices are going to start rising, everything gets out of whack, and it starts distorting your economy. And so that's a really, really bad thing. Something that goes along with that is that the price of your domestic goods get quite expensive. So you've got to pay workers more money because there's a lot of the money is being spent in the economy. That basically makes it much less competitive for you to export anything to the rest of the world. You know, if you're paying people in Wyoming a whole bunch just to sort of buy a hamburger or an ice cream or something like that, then they're not going to be competitive if they're going to be trying to manufacture something or to farm something. And that's something we call Dutch disease. We also know that these resources are temporary. They're both temporary in the short term because the price moves around a lot, and they're temporary in the long term because you've got to pull them all out of the ground. If you're saving your wealth outside your own borders, then you can manage that volatility because you're spreading it all around the world. If that volatility is being pumped into your economy, every year as you receive that income, it's going to make it really hard to plan. So that's another benefit of saving all this stuff offshore. And the final one is just around investment choice. If you start allowing the government to invest stuff locally, there's a big chance that they're going to start making dumb investments, right? They're going to start building a bridge over every fjord. There might be a bunch of guys out in the corner of the state whose vote they want, and they might pump the money there. So it just makes more sense to spread it around. It just leads to safer investment choices. Okay, so let's move on to this Future Generations Fund, the one that you're saving for the long term. And a really good example of this, alongside things like the Alaska Fund that Angela spoke about, a really good example is Norway's fund. Now, this is one of the biggest funds in the world. It's $850 billion. And what they do is they spread all their assets all around the world. They don't have all their eggs in one basket. They have a mix between equities like stocks and bonds, which is investing in interest rates. That mix is given to them by the government. And then within those two different sets of things that they can invest in, the government tells them, you should benchmark yourself against a really diversified portfolio. So they want them to spread their money all around the world as much as they can. But the problem with this is that it ignores the fact that Norway has a whole bunch of oil also underneath the ground. And they also need to think about this oil underneath the ground when they're spreading their assets above the ground. And so this can be done in a whole host of different ways. You might change the types of stocks that you invest in. You might invest less in oil and gas stocks and more in other stocks. Or you might want to take a bigger picture view, which is what this graph shows, which is to invest in fewer stocks when you've got a lot of oil under the ground. And the reason for that is because, on average, the stock market and the oil price move kind of together. And so you want to replace the oil under the ground with stocks above the ground rather than just investing in the same amount of stocks all the time. And so that's a little bit different to the strategy that Norway's taking at the moment and many other funds. The next point to make is around how much money you pull out of that big fund. So at the moment, what Norway does is they have a rule where they spend 4% of their fund every year. What this obviously means is that as the fund gets bigger and bigger and bigger, they're spending more and more and more. And in fact, in Norway at the moment, they're facing the problem that they can't actually absorb all the spending that's coming out of this big fund. And as you can imagine, it's not a bad problem to be having, right? They're spending too much money. But what we find is that a better idea is to spend less of the fund as it gets bigger, because that basically just spreads this, or evens the spending out over time. So what we'd argue is that, Norway should be dropping down to spending, 3% of their fund in the long term as it gets bigger. What does it mean for Wyoming? Well, two things. So in terms of the things that Wyoming invests in, at the moment they're doing a pretty good job because they're discouraged from investing in commodities like coal because they realise they've got all this coal under the ground. That makes sense. They could go even further and invest in fewer equities in the short term to offset some of the risk they have under the ground. In terms of their spending, they're currently spending about 5% of a 5-year average, from what I can understand. A better strategy is to lower that percentage as the fund gets bigger and bigger, just so that you're spending a more even amount over time. Okay, so the final point to make is around these stabilisation funds. We've heard a bit about these stabilisation funds so far. The first point to make is these stabilisation funds are really for when the commodity price collapses, right? It's a rainy day fund. The thing is that when the oil price falls, nobody really knows when it's going to go back up again, right? If anyone tells you they can forecast the oil price, they're having a lend of you. So our best guess at any point in time about what the oil price is going to be in the future is really what it is today. What that means, of course, is that when the oil price falls, the government is going to have to start tightening its belt, right? Because it's just going to be earning less money in the long term. It's just that's just as simple as it is. The problem, though, is that if the government starts tightening its belt too much, you get a real risk of recession. And what I've done here is just a little bit of an example. You can see that the yellow line is the best case scenario, and output there falls by about 2% if the government tightens its belt. Now, this can lead to a recession if the exchange rate doesn't move. And of course, in Wyoming, your exchange rate is fixed with the rest of the US because you all share the same currency, right? So they don't have the freedom for that to happen. So there's a real risk of a recession. And that's that blue line dipping quite a lot lower than the yellow line in the top left corner. A better idea is to let that yellow line go down slowly, to slowly tighten the government's belt over a couple of years. And that spreads out the adjustment. It means you don't need prices to fall so quickly, and that just limits the size of the recession. And so that's what the role of this stabilisation fund is. It's to drip feed a bit of money into the economy to help you smooth to a new level of spending. What it's not, you don't use a stabilisation fund to just keep spending high after the oil price falls, Because that's kind of thinking, well, we're just hoping that the oil price will go up again, and nobody knows when that's going to happen. And so what we show here is that a stabilisation fund, that's just comparing those two examples, a stabilisation fund on the left-hand side can have reduce the amount of welfare loss quite a lot. So a stabilisation fund can really help things out. What does it mean for Wyoming? Well, Wyoming doesn't have independent monetary policy, as we said. So a stabilisation fund is really important here. It should be used to transition to lower spending, not to maintain spending at its previous high levels. That pretty much wraps it up. So I look forward to hearing any comments or questions that you guys have. Thanks for your time.
I never thought of Wyoming being in a currency union with the other states. That's such a wonderful way to look at it, right? Because I guess, I'm curious, is that this whole, the point that in a stabilization fund you can, rather than like trying to throw a lot of money at something, you can kind of drip it in and just help make that transition. Is that something that's broadly recognized in the world of sovereign wealth funds? Is that something new? Is it something people have just sort of done intuitively, or has it been? Go ahead, Sam.
I think that's reasonably well accepted. I don't think anyone looks at a stabilisation fund and thinks, let's keep spending as high as we possibly can. When they sit back and think about it, the risk is just, of course, when the oil price collapses, it's tough. It's tough tightening your belt, and so you just need to keep reminding yourself and reminding people that this isn't about keeping spending as where it was. It's about transitioning to a new level.
And I just wanted to sort of pipe in on Alaska's experience, right? So this oil price fall that we've had this last year and a half, we've had it before, right? Wyoming has seen it. Alaska has seen it. If you all remember in the late 90s, 2000, oil was at $9 a barrel to $14 a barrel, and the sky was falling, right? And there was a huge debate in Alaska at that time as to whether or not we should start tapping the fund. And in 1991, the voters, the Alaskans had voted by constitutional amendment to create a budget stabilization fund called the Constitutional Budget Reserve. It requires certain monies to go in, like if we have settlements, legal settlements, those proceeds from lawsuits go into this fund, among other excess revenues. And it is drawn down under certain rules, and it is required to be repaid. I think that's one of the keys to its creation, is that it's required to be repaid, so that in flush times, the balances go up, and in hard times, those balances get drawn down. I think the challenge that Alaska's facing today on this is that they're drawing really way faster on that fund than they expected, because the votes it takes, it requires a supermajority, a 3/4 vote, to spend money out of that budget reserve. And so, as you can imagine, to get a 3/4 vote, we don't have a party that has that kind of majority. And so to get to that kind of vote, you end up having some compromise discussions on what the appropriate spending level is. And so it's created a really interesting dynamic in Alaska, and therefore the debate about whether or not we should use the fund and how we use the fund, and should it be now making up the difference for the stabilization.
Right, and I think that's, to one of the points I made earlier, that's a sort of strange situation to be in, because stabilization fund should be uncontroversial to access when you need it. So to have the stabilization fund, chained up in the way that it is in Alaska is strange, and it is causing all kinds of strange discussions, as Angela mentioned. So, I'm not saying it should be a free-for-all, but there should be a sort of clear rule-based principle for when and where you can access it, and if the Treasurer and the Ministry of Finance has to do it, people will understand why.
Well, audience, it's your turn. Do we have we're going to have Anne come back up and tell us if she's got some. Oh, wait, first Jason's going to come up.
Well,
One at a time. And before you say anything, I didn't give you enough of a shout out on this Stroock Forum, because I heard a bit of the story from you and Mark last night about how this forum has you know, been something you guys conceived and thought about together, and you've worked on it for many, many years. So congratulations to you too for such an amazing couple of days.
Well, appreciate it. Yeah, and I guess I wanted to thank the School of Energy Resources and the State Treasurer's Office, because you are looking at the staff of the Stroock Forum right now. And as capable as I am, I'm certainly not as capable as everyone who's put this together. We took a chance and we went 21st century to say, if you had a question, to go ahead and text it in. And if you're like me, your phone is still smarter than you. And you can text in a question, but I think we've got a small enough crowd too that Ann McKinnon, who's going to take questions from you guys for the panel, we can do it either way. I think we're pretty flexible. Ann wears a couple hats. She's the adjunct professor at the Hobbs School of Environment and Natural Resources at the University of Wyoming, and she also is part of the board of WyoFile, which is, well, as you well know, here in Wyoming. Yeah.
Thank you, guys. WyoFile, which some of you may not know, is an online news organization for Wyoming that tries to go in more depth than newspapers can afford or choose to do these days. We did get a couple texts, so I'd like to ask these questions first, and then there's some things I was lucky enough to sit through this whole conference and try to understand it. And so there are a few things that I heard at the conference that I think some of you Wyomingites out there would like to hear, so I might try to elicit some of that. One of the questions we got has to do with the challenge of managing a sovereign wealth fund, not the stabilization fund, in times like this when people feel like, oh my God, you know, what's happening to oil prices, therefore what's happening to our government and our economy, both of which depend quite solely almost on those revenues, on that industry. And one of the speakers at the conference brought up the idea, and this has to do with the outcomes that Adrian talked about, that really what this is all about is how to change that coal or oil, in our case, into human capital. How do you, that's the outcome you're really after in the end. You're trying to create this, you're trying to turn it into money, and then you're hoping that you can use that money to create more human capital in your state, country, whatever it is. So one of the questions that came in from the audience is trying to get right to that right now. We have 450 coal miners who were laid off this spring, and they helped get that wealth out of the ground. So is there some responsibility that the Sovereign Wealth Fund should have to those workers, the questioner asks? And so suddenly we have all these people that can't support their families. What is the role of a fund like this? People want to say, so is this going to help me? So you all have talked about what should happen, what are the guidelines, and so in this case, what do you say to the legislature that is thinking about what those coal miners and their families are asking?
So I think that's a fantastic question. It's an interesting point to make, right? It puts such a sort of a personal human face on the problem. I think it's important to make a distinction between the Sovereign Wealth Fund and the government. The Sovereign Wealth Fund is really, it's focused on the long term. It's best just to put it in a bank account, take it out of your mind, and let the guys invest it and make as much money for you as they can. It is super important, though, to think about how Wyoming adjusts to a state of the world where commodity prices are so much lower, and the whole labour force needs to adjust. And so that's a really important role that the government can play, in retraining people, in helping them move where they live, because often where the jobs in the next decade are going to be are not where the jobs were last decade, near the coal mines. And so these are important things for the government to do. They shouldn't be financing it from the long-term fund. Instead, it makes sense to maybe fund it from a stabilisation fund as some of that short-term adjustment.
Somebody else?
Yeah, no, I think that's exactly right. If you can't define the purpose to which this fund exists for, then it will be used on whichever particular issue appears most urgent at any particular time. And I know that current voters are more powerful than future voters, so they will always get to win. We see this in a simple example in New Zealand with the ageing population. There's no way they're going to vote to have less generous pensions. And they also won't be around to have to worry about how I will get mine. And so you have to make some sacrifices now for the future. So get that clear. If what you're talking about is welfare, well then I'm sure there's a welfare structure for the state government. If you're talking about retraining or re-educating, then I'm sure that there's education and retraining roles, etc. That's not about the creation of the Sovereign Wealth Fund. It's about understanding to what purpose is it for, and then you have, the right tool for the right job.
Anybody else?
Yeah, I think, you can only do what you can do. If Wyoming had, in a completely hypothetical scenario, a $100 billion permanent fund, the stream of income coming out of that fund every year would have been much bigger, and the assistance to the coal miners and all the other sectors and actors in the Wyoming economy that are feeling the pain right now would be much greater. And, giving priority to the people suffering the pain right now, as Sam said, we just don't know where the commodity price goes. We don't know where the cycle goes. So it's a trade-off. Helping them now will mean in 4 or 5 years that you might not be able to service your highways and pay your public school teachers and your universities and whatever you need. All the important things that the state needs to spend on.
And I just want to sort of tack on one other philosophical point that Alaska has, and I'm just not familiar if Wyoming has it, but it's the sense that resource belongs to all people. And we pay people to help us monetize that resource and we all have our different functions within the state of Alaska and our role within the state of Alaska, but that resource is a resource that belongs to everybody. That is a philosophical backbone behind all of this, and it goes to the creation of the dividend program. And so to start singling out specific investments or developments or, that goes to the spend question. How do you want to define how this money gets spent? So if it's Norway with 4%, or it's Alaska with a dividend, that's the debate that your elected officials and that you as citizens have to help inform your elected officials to help them create the very clear definition as to how you expect that money to be spent. And if you spend it, and if the choice is to spend it on the 450 coal miners today, then just recognize it's not going to be available for 450 kids 50 years from now. Okay?
There's another, did you want to follow up, Alexa?
No.
There's another question that really kind of follows right on that, Angela, which is, I'll phrase it a little differently to follow what you said, but okay, we need to have this discussion and we need to have clear definitions. So are there good ideas or examples of how to do campaigns to educate the public about these issues, which are not very simple, and we don't see a huge horde of people who have turned out for this event? And how do we talk about it? And I think actually in Alaska maybe is one way to and I think maybe Adrian too, you've talked about how you get it out to people so that they're really seeing it and discussing it.
It's really interesting. I was just having this conversation earlier today with someone. We just had a primary election. I understand Wyoming just had a recent primary election. This is the number one issue in Alaska about what our spending priorities are going to be, where that funding source is going to come from. There's tremendous anger on both sides of the aisle over how their respective legislators represented their views as to whether or not the permanent fund should be used or should not be used, because obviously some people think it should not be used. we had the lowest turnout. 15% of the registered voters turned out in the primary. So it's hard to wonder how to respond to that because people care so passionately, but then they don't show up at the polls to pull a lever for somebody that's going to represent their views at these tables. And Governor Walker, to his credit, has had over 400 town hall meetings on this topic over the last year and a half. You know, I think we just have to keep talking it until we're blue in the face. But part of it is we still have too much money. We still have money in the Budget Stabilization Fund. And there is a view. Oil prices will rebound, right? It's going to save us again, right? Because it always has in the past. So do we really need to make this decision today? Can't we just put it off a little bit longer? We still have 36 months of operating expenditure money in the bank, right? So it's sort of understanding, when does it become crisis? Does it become truly, we're financial people. We tend to plan, right? And so we see this and go, we should be planning because we know this, we see this coming. And if it doesn't happen, we'll adjust accordingly, but we need to plan for this happening. And you have people going, you know what? Wait until it happens, and then I'll be ready to talk about it and talk about a solution. So we just keep talking about it, and we keep talking about it, and we keep talking about it. And we talk about it in forums, whether it's local chambers, whether it's other, Rotary meetings. Right now I am on the rubber chicken circuit. You asked me to come and talk about the fund. I am more than happy to come and talk about the fund and what the options are. And I will do it with any group that invites me in Alaska because it's important.
Well, and you would think in Alaska, because of the dividend program, that in a way is a huge mass media that people can see they're getting more or less each year. And yet, as you say, you still have that problem of people saying, well, maybe we don't have to think about this right now. Yeah. Adrian?
Yeah, I mean, I agree. Clear message, be monotonous, be continuous, just keep at it. One thing that we did initially when we started was we rapidly looked for friends outside of our small society because, and that's what I see repeat everywhere. We all look at your neighbour and think, oh, that must be good, or we trust ourselves the least. And so we went on a global best practice search and we created relationships and partnerships and friends where the rest of the world starts to talk about what you are doing and how that works. And it's amazing how much the people of Wyoming would suddenly start taking pride when people from all over the US and the rest of the world start talking about what a great thing they're doing here. And that's very much what we've used because otherwise the current demand will always win. And that's the little plug for the International Forum of Sovereign Wealth Funds. This is why 31 funds globally get together, compare, contrast, collaborate, and at times co-invest on what is global best practice. One of the constraints that happens across the US state funds is you don't let your people travel because that would cost some money and you might have to go overseas. You've got to get out of this bubble.
I'd like to add something. We have to understand something about human nature. Now, I was in charge of investor education for a number of years, and I learned this from experience. People would be very happy to go, when they want to buy a fridge, they would be very happy to go on different websites or actually go to the stores, get the brochures, and start comparing the products. Should I buy a Sharp or should I buy a Hitachi or a Ford or whatever it is? They do their homework, and then they go and buy. But when it comes to buying a financial product, they don't. They will go and listen to their broker or the financial advisor, and they'll buy. Why? Oh, I trust the guy. He takes care of me. But why is that? That's because deep down, they have this fear. They feel that they are not competent. They can't understand the product. So Harry out there, he has been my friend for 10 years. He works for Goldman Sachs. He knows it, so I trust him. But a fridge is more fun, and I understand it. So I go look at it and I buy the best, particularly when it comes to a car, right? I go test drive, I do everything else before I buy. So when you are talking about complex subjects like what should we do with the mineral trust fund, sovereign wealth fund, because even though you say, okay, it is an intergenerational fund, it is for the future generations. I'm sure at the back of people's mind, they will ask, yeah, but okay, I can see that, but I mean, it's like a fish trap. The fish get in, but no fish can come out. So you're going to continue saving in this thing until it gets ginormous, then what? Right? So these are difficult questions, and you have to understand that. So you really have to go out and reach out to these people and get them to see that these are issues that if you are willing to start talking, and the more you talk, the more clarity you get in your mind as to which way you are inclined. And at the end of the day, you will be more prepared, or you will feel better or more comfortable in terms of coming to a decision, because you know that it is a very important decision. You don't want to get it wrong, so the best thing is defer it, because I really don't want to deal with it at this time.
And just, exactly to what Alex is saying, talk about it in terms of the outcome, not the output. Don't say, hey, I made $1 million, whoopee-doodle. Talk about, hey, I have just meant that you will be able to retire 1 week earlier, or your tax burden will be 1% less in the future. So it's about the outcomes you're after, and suddenly it becomes tangible and real and meaningful, and that's coming back to that purpose of the fund.
And, I'm sorry, Malan, did you want to say?
Yeah, I mean, just one, it's a simple point, and you have to treat it with care, but, I think sometimes it helps to not sort of speak the language of Wall Street and academic finance, but to go back to sort of household finance principles. What would you do if you had a declining wealth source and it was like very unpredictable when it was going to go around? Would you just want to spend it as it come in, or would you rather put it in sort of fund and draw an annuity off it? And if you can do that, now it's dangerous because there are differences between household finance and fiscal finances. But as far as you can go with simple household finance analogies, it's quite powerful.
We have just time for one last question, and one of the questions takes you right back to the sort of the pressures of today. Well, if there were a panel of development economists up there, says the questioner, they would all say you should spend some of that wealth diversifying your economy, and that will expand the economy, and that helps the future generations. So how about that?
Well, as a development economist, so that's exactly right. And so I guess one of the first distinctions I made on the slides was that all those recommendations were for a developed economy like Wyoming. For a developing place like Ghana or Uganda, it's a completely different kettle of fish. And the reason is because those countries can't get access to capital to invest in their own economy, right? But a place like Wyoming has pretty ready access to borrowing. They've got quite a lot of capital already, and so the real risk that you've got to worry about is white elephant projects, building things you don't really need. In Ghana or Uganda, there's pretty much anything you invest in they need, because they don't have, it's clear, sanitation, they don't have enough roads, they don't have enough hospitals, anything like that. And so it's a different kettle of fish. There's a reason why people aren't lending to Ghana and Uganda. It's because they don't properly understand the risks, and they're worried about political risk and all that sort of stuff. Whereas these are the sort of things you can overcome with your own sovereign wealth fund. So, yeah, they are quite different cases.
Yeah, and I would just add, I agree with all that. Again, the track record of heavy-handed state efforts at diversification is not always a happy one. And, your ability to do that off a volatile revenue source, you're halfway building that bridge and then the commodity price drops on you. So, I think that's where a stabilizing and sustainable outcome that you achieve through your sovereign wealth fund is quite useful, because it gives you a longer planning horizon, gives you more predictable cash flows for long-term investment projects that might help diversify the economy.
We are at the end of our time. I have many more questions than I've been able to ask. These guys I think we'll have tolerance for you buttonholing them before they can escape. So those of you whose questions didn't get asked, please, they're a bunch of really nice people, as you can tell, and they've come a long way. They're interested in grappling with some of these Wyoming questions for us. So I think we'd like to have you thank the panel and thank you all for coming.
I'd like to second that and offer Treasurer Gordon the very last word, please.
I was just waking up. Tell me how good we were.
Well, thank you to the panel, and thank you, Jay and Mark Northam. You know, this was an inaugural effort, and it's interesting. If you'd stayed home, you could have watched Hillary Clinton respond to Donald Trump's bigot remark, but I'm glad you're here. Tonight is an important first step. We're looking forward to continuing this, I guess, next year maybe in Alaska. But clearly, and Kathleen, I want to thank you especially for making the effort to come here and help moderate this panel. You know, clearly, sovereign wealth has a role to play in our future. I have many of those questions that I'm going to grapple with you guys with. But thank you for coming tonight. And God bless Wyoming. God bless America. God bless you all on your way home. Thank you very much.